Alright, now we have some questions on investment in equity securities that will enhance our understanding. Question number 1. On December 31st, Ott company had investment in equity securities as follows. Since there is a very nice determinable fair value, we have three investments, MAN, Chemo and FEN. They have the cost irrelevant, they have the fair value, so we will take these readily available fair values. It says Ott December 31st balance sheet should report the equity securities as, since we have the determinable fair value, they must be reported at 28. So that makes B to be the correct option, and B it is. So when the fair values exist, we must measure at fair value. Next. An entity should report an investment in marketable securities that does not result in significant influence. If the holding is between 0 to 20%, it means we do not exercise significant influence or control. So what are the options available? How we can report them? Lower of cost of market withholding gains and losses included in earnings. Wrong. This lower of cost of market is used for stock or inventory, not for the investments in equity securities. Wrong. Lower of cost of market withholding gains included in earnings only to the extent. Wrong. Again, this is related to the inventory, not equity securities. C. Fair value withholding gains included in earnings only to the extent of previously recorded holding losses. If you have equity securities holding between 0 to 20%, it doesn't mean how many holding losses or gains were recorded previously. If gain is gain in the current year, you book it as a gain. If a loss is loss, you book it in the same year, irrespective what was the gain and loss last year. So fair value withholding gains and losses included in earnings, irrespective what was the prior year's earnings or losses. So that makes D to be the correct option, and D it is. Next. Plaque company purchased 10,000 shares, that is 2% ownership. Yes, our holding is between 0 to 20% of Thai Corporation, so it means we have to apply this method, equity securities investment at fair value. We bought these investment on February 14th and did not elect the fair value option. Fair value option was not elected. Plaque received a stock dividend of 2,000 shares on April 30th. Since we already had 10,000 stocks, we further received 2,000 shares, mean our total number of stock or shares go up to $12,000 when the market value per share was 35. Okay. Thai paid a cash dividend of $2 per stock or per share in its income statement for the year. What amount should Plaque report as dividend income? Since you hold 12,000 shares and the company Plaque, they have issued $2 dividend for each number of shares. So it means the total dividend income that you would receive and you must report is $24,000. So that makes B to be the correct option, and B it is. Next, during year 6, Wall Company purchased 2,000 shares of Hum Company, properly classified as trading securities, for $31,500. That was the initial investment at $31,500 when? Year 6. And they represent 2% of ownership in Hum Company. 2% means very little investment, no influence at all. So what happened? The fair value of this investment was $29,500 at December 31st, year 6. At the end of the year, the investment has fallen to $29,500. Yes, there is a loss. This would be the new basis, new carrying value from 1st of January, year 7. Loss would have been recorded in year 6. Yes, a loss of probably $1,000. $1,000, it's $31,500. It's $2,000 loss. This loss would have been booked in the income statement ending 31st December year 6. What happened? Wall sold all of the Hum Company stock for 14 per share on December 15, year 7. December 15, year 7. We sold all these stocks for what price? It said for $14. That's the carrying value, which you call the book value. We sold all our investment, 2,000 shares at the rate of 14 each, which means the price we receive was 2,000 multiplied by 14. It's 28,000. That's what we received. That's what we received, disposal proceeds. But it's not without commission. We also had to pay $1,400 in brokerage commission and taxes. So what is the net amount we received? Net disposal proceeds. Net disposal proceeds once we sold them. We sold them for $28,000, no doubt, but we had to pay $1,400 of brokerage commission and taxes. It means net amount we received on our hand was $26,600. 26,600. So this is what we received in net, and this is what was the book value. So comparing what you received versus what was the book value, we can see a difference of 2,900. It's a loss. Yes, it's a loss, because we received net 26,600 for investments that had carrying value 29. So there is a loss of $2,900 that must be booked. That makes C to be the correct option, and C it is. Next. At the end of year 1, Lane Company held an investment in equity securities that cost $86,000 and had a year-end market value of 92. Original cost is irrelevant. When we have the market value, we take it as a base. That's the value we will consider. That's the year-end market value. When? At the end of year 1. 31st December year 1, the value that we should consider is $92,000. Original historical cost is irrelevant. The same value on 31st of December year 1 would be carried forward on 1st January year 2 as $92,000. Okay. During year 2, all these securities were sold for $104,500. So within this year we sold them, and we sold them for $104,500. In green color means that's what we received. The net difference between these two, $104,500 less $92,000, is a nice handsome gain of $12,500. That's what we sold for. This is a gain. Okay. There is another transaction also. At the end of the year, Lane had acquired additional equity securities for $73,000 and had a year-end market value of $71,000. So these investments that we bought for this much had a market value or a fair value of $71,000. So this is what you bought for. This is the fair value. So there is a loss of $2,000. The question says, what is the impact of these stock activities, all of these, on income statement in the year 2? Since there is a gain, yes, a gain of $12,500, and there is a loss, yes. Combining these two, because we have to report net, so it's going to be $12,500 less $2,000. So there's going to be a gain of $10,500. So that makes B to be the correct option, and B it is. B it is. All right. Moving on to the next question. Apparently looks a very difficult question, but it is not. You have to be careful while reading the requirements. It says, what amount is the net value of investments at the end of the year? We just need the closing valuation. Apparently the question has so many twists and turns. Janssen traded stock in Flex Company marketable equity securities during year 1 as follows. We had these many shares purchased in 3rd of February year 1 at this price. We again bought these many shares at this price. We sold at these many shares at this price. We again bought at this price, and we sold at this price. So there is so much movement. Some students will simply get confused between these purchase and sales. What we need is just the closing valuation. How many shares are available and what should be their valuation. So for this, what we will do, we will consider right from the start. We had these many shares. We bought these, sold, bought, and sold. So it's going to be 1,100 shares plus 2,500 shares less 750 shares plus 1,400 shares less 4,000 shares. It gives us just 250 shares at the end of the year. We just have these many shares in the balance. And none of these price is relevant because we need to take the price that is relevant at the end of the year. It says not this even. Flex is trading at 10 per share when at 31st of December. So at the end of the year, the market price, the fair value at the market price is $10. If that's the price, so 250 shares valued at 10 each gives you the fair value of your investment at 2500. So this is the value you will report it on your balance sheet. So that makes B to be the correct option, and B it is. Next, a company acquired 30% of company B's voting rights. 30% is quite a sizable investment, and if you remember, if the holding is between 0 to 20%, it's little or no influence. If the holding is between 20% to 50%, that is quite a sizable investment. We use either an equity method, which we discussed in 2.6, or we use the fair value option we just discussed a little while earlier. And if the holding is between 50 to 100%, we go for consolidation. That's the subject of topic 2.8. We'll do it later, tomorrow probably. So we have this much investment, quite a sizable one, 30%, and account for its investment using equity method. Okay. On January 1st, year 2, company A sold 60% of its investment in company B. Let's say you already held 30%. Out of this 30%, 60% has been sold. Which means, let's take an imaginary number just for the sake of understanding. The company B had total 100,000 shares. Out of these, company A acquired 30%. That means 30,000 shares. Now, out of these 30,000 shares, 60% are being sold, which means 18,000 shares are being sold, and out of which remaining 40% are still with you. That means 12,000, which means your holding has fallen from 30% to 12%. Over the period, your holding has fallen from 30% to 12%. That's what has happened over the period. So on 1st January year 2, company A sold 60% of its investment in company B for $150,000. The carrying amount of the investment on January 1st year 2, when we sold, before the sale was 210. The fair value of the retained investments after the sale was 100. What gain or loss, if any, on the disposal transaction should we consider? Now this is an interesting question, and that needs a little suggested approach that will help you solve a question like these. We have an investment that changed its form from equity into fair value, into investments that is between 0 to 20%, 12%. We need to determine what was the gain and loss. We need some comparable numbers. We must compare two things with these. Then we will be able to determine whether there is a gain and loss. At one end, you will contain the fair value of remaining investments, and on the same side, you will consider how much you received, disposal proceeds, net disposal proceeds. This you will keep at one end, and on the other side, I will fill in the numbers once we read draw the format. Book value or carrying value of investment before disposal. This will help us determine what should be the gain and loss. At one end, we will have the fair value remaining plus net disposal proceeds, and on the other side, we have book value or carrying value of investment just before disposal. Let us plug in the numbers. It said the fair value of remaining investment right here, the fair value of the retained investment or remaining investment was $100,000, right? Net disposal proceeds, what did we receive by disposing 18% of our investments? It said the investment was sold for 150. That's 150 right here. And on the other side, you will write the value of investments before disposal. Before the sale, the value of investment was 210. Right? The value of investment was 210. So total of these is 150 and 100, 250. And the value here, the book value, was 210. Comparing these two, we have higher amount of fair value of remaining investments with net disposal proceeds and low carrying value. So you can have an idea that the book value of an investment 210 has brought us 150 and still 100 is remaining. So 250 is greater than 210 means disposal plus the remaining balance is still more than the book value of the investments. So the difference between these two represents a gain of $40,000. That makes B to be the correct option. Let us just twist the things bit to get a better understanding. Had there been less disposal proceeds, for example, let's say the disposal proceeds would have been just 70,000, for example, which means 70 plus 100, 170. The total sold plus remaining is 170, whereas they were in the books for 210, clearly telling us that there is a loss on disposal of $40,000. That's not the case, right? So that's how we compare. We keep the fair value of the retained or remaining investment plus net disposal proceeds on one side and the book value or carrying value investment before disposal, and their comparison would get us the gain or loss the way we have calculated. So right now B is the right answer and B it is a gain of $40,000. Next, which of the following is a false statement about the measurement alternative for an investment in equity securities? Again, which of the following is a false statement about the measurement of alternative for an investment in equity securities that does not result in control or significant influence? Means your holding is between 0 to 20%. Let us read them all so as to convince ourselves we selected the right option. The first one. Under the measurement alternative, an impairment loss is recognized for the excess of carrying amount of the investment over its fair value. Absolutely right. That's what we have discussed. If there is a decrease in the investment value over the period, under using the alternative measurement, it's a loss for the period. It's a correct statement. It's a correct statement. C. The measurement alternative cannot be elected when the fair value of the investment is readily determinable. Yes, that is true also. If the fair value is readily determinable, we cannot use alternative method. That is true as well. The measurement alternative cannot be elected when the fair value of the investment is readily determinable. That's a correct statement. If the measurement alternative is selected, it must be applied until the investment has a readily determinable fair value. That is true as well. We should continue applying measurement alternative until readily determinable fair value is available. That is true also. So B, C, D are correct. All these were there in the text we just read a little while earlier. What about A? The investment is measured at fair value through net income. Wrong. If you are using alternative measurement of alternative investment, there is no fair value. There is no fair value. We have to determine value in a different way. We have to use a formula that is cost minus any impairment loss minus any price changes. That's the formula that helps us determine the loss. We don't use fair value method. That's the false statement. A is false. A is used for investment between 0 to 20% for those investments that have readily measurable or readily determinable fair value. Wrong. A is wrong. Next, under the measurement alternative for an investment in equity securities, the investment is measured at what? It is not measured at amortized cost. You will discuss it in your investment in debt securities. Bonds are reported as amortized cost. We'll discuss. Lower of cost or net realizable value, that is for stock or inventory, not investments. Fair value minus subsequent impairment, not subsequent impairment. Wrong. It's cost minus subsequent impairment plus or minus price changes resulting from observable price changes for the identical or similar investments of the same issuer. So for this we have a formula. Let me show you. That's the formula. Value of investment is equal to cost minus impairment plus minus price changes. Right, so that's the point. So that's the reason A is the right answer, and A it is. Next, a measurement alternative may be elected for an investment in equity securities if, moving in the reverse order, a measurement alternative may be elected for an investment in equity securities if the listed price of investments are available. If the listed price are available, it's a fair value. If listed prices are available, you cannot use measurement alternative. No, if listed prices are available. If listed prices of investments are not available, an investment allows control over the investee. If control is available, then you go for consolidation. It's consolidation. That is the holding between 50% to 100%. Wrong. Investment allows significant influence over the investee. If there is a significant influence, that is holding is between 20% to 50%. In this case, we have two alternatives. Either we use the fair value through other comprehensive income, or we have the equity method discussed in 2.6. B, C, D are wrong. So yes, fair value of the investment is not readily determinable, and investment does not result in control or significant influence. Only then we can use the measurement alternative, when the readily available market determinable fair value doesn't exist. So that makes A to be the correct option, and A it is.